Hi folks, welcome to a product review at Finominal. Today we're going to have a look at AQR's equity market neutral fund that trades under the ticker QMNIX. Now, this fund is probably the best way to learn about the current state of factor investing, and that is simply because it provides exposure to long-short equity factors and primarily value, momentum, and quality as seen as in financial research. The way the portfolio is constructed is by currently 1,000 positions in the long portfolio and 1,000 positions in the short portfolio from a universe of global stocks. And it is constructed beta neutral as per the fact sheet, but let's have a look in terms of what we find out using our tools. Now, we're going to have a look at the drivers of risk return via a returns-based factor exposure analysis. And we're going to first focus on the exposures to asset classes. Now, this is a equity market neutral fund. And indeed, we can see that the beta to the S&P 500 has been pretty much zero over time. We also see the exposures to bonds, currencies, and commodities has also been zero over time. And so this fund primarily provides exposures to equity factors. And specifically, we can see the consistently positive exposure to the value, momentum, and quality factors. We do see that the exposure to the low volatility factor has been zero on average, and exposure to the size factor negative. And the negative exposure to the size factor simply means that AQR in the stock selection process prefers large caps, which are liquid, over small caps. Again, given that it's a global stock universe, that probably makes sense. Now, that's in terms of what the product is offers. And let's see how useful this would have been using our diversification booster tool. Now, we're going to have a quick look in terms of how helpful it would have been allocated to this. Now, we see, of course, the correlation to stocks has been close to zero, to bonds and so on. And we can simply simulate adding a 25% allocation to a portfolio comprised of the S&P 500. Now, we can see that the CAGR would have decreased slightly over the last 9.5 years, but also a significant reduction in the maximum drawdown, from negative 34% for the S&P on a standalone basis to negative 28% if combined with QMNIX. Now, this effectively results to a significant increase in the Sharpe ratio from 0.7 to 0.85. Stated differently, QMNIX provided significant diversification benefits to investors. Now, that's for QMNIX on a standalone basis. Now, let's see how this would have done compared to its peers. Now, it is worth mentioning there are very few long-short market-neutral equity factor products. The one that comes to our mind that is most similar is a product from Vanguard. And we can see this would have exhibited the same trends. We also see the cyclicality of factor investing in general. Now, please remember these are excess returns, right? Because these both portfolios are constructed market neutral. We can see the boom in factor performance up to 2018. And then basically when investors lost significantly by allocating to these traditional factors, i.e. value, momentum, quality, between 2018 and 2021. Now, since then, there's been fantastic recovery. And we can see both products kind of like have the same trends. I think the Vanguard product is slightly less volatile, but they offer the similar exposures. Now, one of the key differences between these two products is not only that the volatility of Vanguard is slightly lower. From a Sharpe perspective, actually AQR is looking better, but the fees are different. AQR is charging 1.3% for that share class versus 14 basis points for Vanguard. The larger problem is that it's actually difficult for most investors to access these products because they have high minimums or are only available to institutional investors. So let's compare AQR to two products that are available as ETFs. Now, the first one is a product from Franklin Templeton. Now, this is actually a cross-asset product, so it doesn't only provide exposure to equity factors, but also to factors in fixed income, currency, and commodities. The second product is one from Simplify. that does only focus on equity factors, but only has a very short track record. So let's first look at those products from performance perspective. We do see the performance of QMNIX since almost a year ago, which has been a steady upward trend. We do see the performance of the Franklin Templeton systematic style premium product has been much more muted, but we do see kind of like similar trends here over time. And we see the performance of the product from Simplify, which is, well, again, you kind of have similar up and down moves, but much more muted. And from a performance perspective, we do see the AQR product has had a much higher return on that period. We do see the annual fees for FLSB is 65 basis points, significantly cheaper. For Simplify, there's no data at the moment because it's been listed only recently, but it's 1% of the charging. But the performance is much worse. Now, that kind of wraps up our analysis of QMNIX. And so from our perspective, this product does exactly what it states in its name. It is equity market neutral. It is exactly providing exposures that we see in academic research. And in fact, we replicated QMNIX numerous times. If you do the theoretical product, it's fairly close to the actual product, which is great. And it has provided significant diversification benefits. The only downside of the product is that it is not available as an ETF. We'd love to be the case. And as you can see, the other products here are not quite as good. Now, that kind of wraps it up. Hope this is helpful. Have a nice day.